Never lose money again by using life insurance the right way. My name is Carmen.
And I'm Darius. Recently, we came across an interview from a millionaire rapper, Waka Flocka, where he discussed how he uses whole life insurance to put money in and take money out and make money in the process.
Exactly. Now go ahead and check out this clip right here.
When I know I had all the millions and I didn't even have a credit card, the dumbest. I was like the dumbest person ever. I used to spend money on everything. Man, please. Yeah. Please. I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. Mm-hmm. I never lose my money, ever. And anybody get money, I'm giving you a promissory note. Because you gonna promise to pay this back, I'm gonna bring you to court.
I'm ready for the Waka finance.
So let's go ahead and jump into the points. So there's 3 points that we just want to cover with this snippet that he was talking about. And not only Waka Flocka is doing it, we've talked about many times on our YouTube channel how politicians are doing it, how millionaire families are doing it, and how we're doing it too. So why don't you go ahead and join us? So the very first point that we want to talk about is opening up a whole life insurance policy that has cash value. Now, when we talk about this, there's some nuances that go into this, right? We're talking about a policy that you overfund. You can hear that term before. You're putting money specifically into the cash value of the policy so that it can grow at a compounded rate and that it allows you to have liquidity inside the policy. Mm-hmm. Now, the best thing to know about this is a lot of times people don't understand that this option is even available to them when it comes to life insurance. Because I know when we were taught about life insurance in the beginning of our marriage was just you buy something called term insurance, which is insurance that has a death benefit. And if either of us were to pass, then we would collect on the death benefit. And there's really nothing else that you can do with that particular product. Mm-hmm. But with whole life insurance specifically, you are covered for your entire life as long as you maintain your premiums. And there is a cash value, or there is cash that grows inside of your policy throughout the life of your policy. And the best thing to know about this is the cash is available to you to use at your discretion whenever you choose and however you choose, which gives you a lot of flexibility as far as what you do with the funds.
Yeah, one of the things that he mentioned in the video is the fact that he was spending cash for everything that he's purchased, and he had this idea, or it was presented to him, that he could borrow the money, spend that money, and pay himself back the interest. Mm-hmm. That's how he's going to not lose money on anything that he does. Yeah. Now, when we talk about the fact that you're borrowing money from an insurance company, we're not saying you're borrowing it from your policy. The reason why this is important is because you have to continue the growth or continue earning interest. The only way you can continue to earn interest or compound is if you don't touch it. Mm-hmm. That's how you get the phrase, or that's how you get the idea of borrowing money, because you don't want to disturb the policy growth. Mm-hmm. Now, the next thing that you want to make sure that you do is you want to pay that money back, just like if you were to borrow money from a bank or any other financial institution. The only difference is you're using your death benefit to borrow money from the life insurance company.
Yeah, you're essentially getting an advance from your death benefit. So the insurance company is going to siphon portions of your death benefit and make it available to you every single year. And again, it's to your discretion how you decide to use that money. We always recommend, like Darius said, you borrow the funds from the insurance company. They basically look at your cash value and go, okay, if you have $50,000 of cash value available, I'm going to give you my $50,000 so that you don't disturb the growth inside your policy and it continues to grow at a compounded rate. And the best part about that is because if you compare that to a savings account, right? If you take $50,000 out of your savings account, that money is gone and it's no longer earning any interest because there's no more money or the principal has been affected. So that's why we really love using whole life insurance policies, particularly because when you borrow the money from the insurance company, yes, there is a fee with that, which we talk all about our channel. So there's hundreds of other videos where you can find out that information. There is a fee, but the fee is still worth us using other people's money as opposed to disturbing the liquidity inside of our policy.
Yeah, and I think the piece that people miss, or the piece that we don't stress enough, is the fact that none of the money is borrowed from your insurance policy, but the interest that you pay back to yourself goes to your policy. Mm-hmm. So the only thing that continues to grow your policy, or anything that goes back to your policy, is the difference in interest that you've paid. I think the important piece that we miss when we talk about borrowing money and paying it back is, let's say, for example, you need a new washer and dryer and that costs $3,000. I don't know if that's a good washer and dryer, but I'm just throwing a number out there.
Yeah, that works.
You borrow $3,000 and the money that you pay back is 15%. let's say you use your credit card and your credit card costs 15%, and over 3 years you'll be paying this back. Now, if you were to borrow this money from your insurance company, what you would do is you would borrow $3,000 from the insurance company, pay back the 15% over the same time frame, but the difference in interest would actually go back to your policy.
It would, the difference would grow your policy because the insurance company isn't going to charge you 15%, or at least as of today's video, right?
Yeah,
as of today's video, our highest interest that we're paid on a loan is 5%.
5%. Now, the difference of 10% on that 15% interest rate, it will go back to the insurance policy. The interest goes back to the policy.
Yeah, it goes back to your specific policy, and that's going to help compound the policy and grow over time. So the point that we're trying to make is when you open up a whole life insurance policy, you have the ability to utilize the cash value in ways to help you finance your lifestyle. And why is this important to you? It's important because you have to understand that you finance everything that you buy. And the way in which you finance everything you buy is you either have to save the money, right? You have to build, save up the money. And then when it comes time for you to spend it, it goes down. Right? So that's financing, because at some point you're making payments, right? Aren't you making payments into your savings account? That's financing. Or you go into debt and you go, here's zero, you go down, and then you pay it all back. That's financing too. So once you understand that concept, then you have to start looking at other ways to be more strategic. So what we do is we use OPM, we use other people's money, we borrow, we pay it back, but because we borrow from our policy, our cash value in our policy is still continuing to earn a compounded rate. And whatever money that we contribute more in interest is going to help grow our policy. So the last point as far as how this all works is we talk about lending money. So are you lending yourself money to buy the washer and dryer? What are you doing as far as recapturing or financing your lifestyle through your whole life insurance policy so that you never lose money again? We literally use our policy to pay for our monthly expenses because we recognize that it's not about how much money you make, it's about how much money you keep. And if we, for example, make $100,000 a year, we want to try to keep as much of that $100,000 as we possibly can so that we're not just spending money with no plan on getting it back.
Right. And I like how in the video, he also mentioned that he uses a promissory note so that if people don't pay him back, he can take him to court. The promissory note is basically his contract that he creates with an individual that he lends money to so that he can get that money back. It's no different than a bank. He's become the bank. When you work with the bank for any particular loan, you have a contract that you say you promise to pay XYZ for a certain percentage. He created the exact same thing with a promissory note that is binding in court.
Absolutely. So the main thing that we want to get you to learn is that whole life insurance can be used in different ways. You just have to learn the product and how you can use it to accomplish your financial goals. And if you want to learn more about that, check out our next video where we can teach you all about how to use the system.
Remember to own your own lifestyle,
or someone else will.